Okay guys, welcome to today's video. So we will quickly be talking about breaker block, mitigation block, and imbalance. Okay, of course there are other forms of entries that we can use, and both, we've talked about order blocks, right? We've talked about order blocks, right? You know what an order block means, just as the name implies. Order block area on your chart where you have zones or area where there are lots of orders, either buy or sell side orders resting, and point of interest where you want to buy from, levels of what demand and supply. But there are other areas we can also use as what point of interest while looking for what trade entries in SMC, right? If market does not get your order block, there is also another block called a breaker block. There's another block called a mitigation block, and an imbalance that can serve as a what point of interest for you to buy or sell from, or to take your entry trades from. So then you have seen several times on chart, maybe when market goes into higher level time frame key levels where you want to buy from, and you are looking for that confirmation entry, then all of a sudden you go to the smaller time frame, you mark in the order block, and price does not even come to that your point of interest, and price started going to your proper direction. We have seen that. So this means you need to now learn other forms of areas that you can use as your what point of interest for taking trade entries. Still the same thing, we are still going to be considering liquidity, we are still going to be considering what market structure. So it's a huge topic. So I don't want the video to be too long. I'll just try my best to keep it very very brief, and if we cannot finish it here, we would continue. We'll just segregate it to different parts. So you need to understand it. You know what an order block is, right? So I'm just going to be specifically talking about how we can identify a breaker block, a mitigation block, and of course we've talked about imbalance in the past. Okay, so for a breaker block just means a failed order block that has failed. For example, in a bullish scenario, market is buying, right? When market creates a break of structure, okay, let's do it like this. When market creates a break of structure like this, right? Your demand zone close to this break of structure is this, right? So this, for this structure, this is your order block. What are you going to be looking out for if you want to buy this order block? You'll be looking out for price, right? For market coming down to this place, maybe creating a form of inducement, then goes up, come back down before you enter. Then all of a sudden, market just comes down and take it out, right? Now this order block has failed. Take it out aggressively. This order block that has created a previous break of structure has failed. Okay, it created a break of structure to the upside. It has failed. Now what happened? This order block that has failed is called a breaker block, right? So when market is coming close to the breaker block, we can have another entry, right, for a continuation to the downside. Now we don't just buy it like this. Of course, this is just a sample, me showing you how to identify it. Of course, there are other things we need to look out before taking trades off a breaker block, which is liquidity and the rest, right? I'll be explaining that when we're looking at how to catch that entry. But for this is just how to identify it, right? When an order block that has failed market book structure, you saw a shift in trend, you saw so many things that you saw market creating this structure for an imbalance. So how do we identify a proper breaker block? The breaker block should be taken out with an aggressive movement to the downside on a bullish scenario, right? Let me take this out so that this, it must have created what, a break of structure to the upside or to the downside in a sell scenario, right? Let me bring a sell scenario here. Right, so this is for market was bullish, market changed structure to bearish, market was bearish, market structure to bullish. So it's a bullish, or can I say it's a bullish or a bearish reversal. So for breaker blocks are reversals, for reversals. Mitigation blocks are for continuations. Breaker block are for reversals. Market was bullish, then all of a sudden the last order block that created that bullish break of structure was taken out, the market changed bearish. Market was bearish, then all of a sudden the last order block that created that break of structure was taken out, the market shifts, right? Market now shifts to becoming bullish. Same way, this now shifts to become bearish, right? So this is a bullish and a bearish scenario for breaker blocks entries. Now what do we look at first, right? There must be a clean break from this breaker. There must be a clean break. It means market will break, and what is going to be the relation of the break? An imbalance should be there, right? An imbalance tells us of when market creates an aggressive movement and creating those inefficiencies in price. We want to see that. So we are not looking for a structure like this. Say for example, let me take this out. Okay, we're not looking for something like this. Let me clone this. Then you say, okay, this is an order block. This is your order block. Then price is now coming like this, just dancing or ranging towards. We're not looking for market ranging around that side before coming down. No, right? We're looking for something clean, an aggressive movement that takes out this order block, an aggressive movement that takes out what? This order block. Then this place that has been taken out is now called a breaker block. So there are things to look out for to catch a trade. Remember, now market has violated this order block and shifted structure to the downside. Market also created what? A sell order block here. So this is why people miss entries. So you'll see a sell order block, and now you have a breaker block. How do you know which one to take trades off with? How do you now know where to take trades off with? That is where liquidity comes in. Remember, when we talked about liquidity, we talked about how to pick a point of interest, an order block, how to pick a valid order block. We said we would use the point of interest that is closer to liquidity and unmitigated. That means it has not been tampered with. If you don't understand what I'm talking about, go and watch. I don't know the exact day, but the day we talked about point of interest and order blocks. Okay, so for example, how do you know which one to use, right? If the market is going back up here and does not create a form of inducement or a liquidity, you will not take. But if there's a form of inducement like this, of course now you want to trade off what? The breaker block. But if the market is just coming aggressively back, you don't want to take trades there because you are an SMT trader. You're after liquidity to liquidity, right? So the market might want to now take out the breaker like this and induce. Then when you see this move, you know that, oh, you're not going to use this breaker. Now you now want to use what? The order block, right? And induce, you now want to use the order block. But in a situation where market induce close to the breaker block without even mitigating it, then you don't want to start waiting for your order block. Market's not going to get there. It's going to tap into the breaker block and sell. And of course you want to take profit below. As simple as it. So this is a typical example of what? A breaker block. Now what is a mitigation block? Now we say a breaker block is it's another block that failed, right? It's another block that failed, right? But what about the mitigation block? A mitigation block does not even create. It's a block that mitigates, does not create a break of structure, for example, and is always available for continuation. Now you can see breaker block is used for reversal. Market was bullish and all of a sudden market now turned bearish. For example, if you have, let me give you an example of mitigation block. Market was bullish like this, right? Then create a break of structure to the upside. Okay, now this is a mitigation block right here. This mitigation block now, this area that market took out aggressively, right, is called a mitigation block. Now this mitigation block did not, if you look at it, it did not change structure. It did not create a break of structure to the downside. It must not. It must only what mitigate the previous what order block. Right? It must what mitigate the previous order block without creating a break of structure to the downside. Because if it creates a break of structure to the downside, it has shifted. The structure has changed, right? So it must be something like this. Then creates an impulsive move. Market now creates that impulsive move to the upside aggressively. Now imbalance must be there. That's the relationship between a breaker block, mitigation block. There should be imbalance that created this move to the upside. Right? Now, this move has also created an order block for you. This is why a lot of people miss entries. Now, market has moved aggressively. You are looking, where do I want to trade off? You do not identify let's say you don't know what a mitigation block is. You are waiting for market to come to your order block. Then all of a sudden, market creates what? An inducement move like this, came back down, and you are waiting for your order block, and market taps into the mitigation block and continue buying to the upside. It happens every time in the market. All as long as what is the thing we need to see now before we trade off a mitigation block? There also must be an inducement. It's the same rule we use in picking our point of interest for order block. The same way we want to trade off an order block, an inducement is created, structural or engineered, and that level remains unmitigated. Okay, market comes into it, instead of what buying off, you see. So you can see this. Now the difference between a breaker, this breaker block usually for a reversal, mitigation blocks usually for a continuation to the upside. Same thing for mitigation blocks in a sell scenario. Say market has been selling like this, right, creating that sell to the downside. Then you see an aggressive movement to the downside, right? Now market has sold, broke structure, creates another block right here. Where is it? Okay, creates this other block right here. But market does not come back to the other block. It uses what? The mitigation block right here. For the entry. The move where market broke the structure, where you usually draw your line and say break of structure. That block where you draw your line and say break of structure, that is called the mitigation block. The last candle, this candle made a bearish move. The market aggressively broke the structure. That last candle before this break, where you draw a line and say break of structure, that area is called the mitigation block, right? So market coming back, instead of tapping the order block, it creates a form of inducement and sells from the mitigation block. I think there should be an example somewhere, so that I don't really want this video to be long, so there should be an example. Let's go and see if we can catch an example. Okay, where is it? Okay, there is one here. Let me refresh this so I can see well. Breaker mitigation block. Okay. There are many. Okay, let me pick the one I'll just give you guys for example. There's another one here. This one that happened here. This one too here. I want to look for a clean one I can just use to teach you guys so you understand very well. I think this is BTC. Look for a very clean example. I didn't check this before doing this video, so sorry guys, I'm just in a hurry. Need to do this very fast. Okay. Okay, I think there's one here. Okay, good. Now look at this structure. This structure, market was bullish, right? Market was making bullish moves. Then we saw market shifting structure to the downside, right? Market shifted structure from here. Market started moving bearishly to the downside. Now this market broke out aggressively. Look at this candle. This is the kind of candle you want to see. This kind of imbalance you want to see, right? Market moved from here to this low. You can see this low did not even create a break of structure, so it's not an order block, right? Just like what we are looking for. Then all of a sudden market creates an aggressive move to the downside, right? This last candle here is our mitigation block, right? While this region here is our order block. So market has given us a mitigation block and an order block. Remember the structure. Where is it? Oh my god. Okay, remember this. No, this is breaker block. Mitigation block, this, right? Market broke aggressively to the downside. This move that created the order block that breaks structure, the low that created the order block that breaks structure, is the mitigation block. This was a low that created the order block that broke structure. Right? Let's go back to the image. A low, right? Move up. It did not break a previous low. It did not break the previous high, right? It created a pullback, and this pullback led to the break of structure to the downside. Aggressive one, right? Not as this one's aggressive movement. So what do we identify here on chart? There's so many. Market makes backtesting it will be very important for you guys. Now market did the aggressive. You want to take note of aggressive movements, right? You can see the way market has been moving since, but after creating this low to the upside, then all of a sudden we see the aggressive movement, right? Now when I want to pick a breaker block or a mitigation block, I always use the body. I don't like using the what. I use the body as the low sell scenario. I use the body as the low. Then I can use the wick as the high. Okay, now this bullish move, this last bullish candle that make the move to the upside is the what is the what mitigation block. Then all of a sudden market boom. Now mitigation, this is bullish block, this is what a move to the downside, right? So a lot of people call it's not a breaker block, it's a sell scenario. Okay, so now what happened? Market induced immediately after the break. You can see it here. Market started ranging, but it did not mitigate the breaker, the mitigation block. Sorry, it didn't mitigate the mitigation block. Then all of a sudden, a lot of people waiting for they will say this gap here is a fair value gap. They'll be waiting for price to come what to this other block. But look what happened. Price mitigated the mitigation block, and all of a sudden start selling to the downside. So you're taking a trade here, full TP below this region, and price did not come to the what order block for the sell continuation. I hope you guys understand. It's a very kind of simple move. There's also another example of a mitigation block here, right? Now market made a move. There was a low here that created this movement. Market shift structure aggressively, right? This last candle, this last bearish candle that made this move is the what mitigation block, right? If you don't understand this, you need to watch this video and backtest. And this one is the what order block, right? So what happened? Market induced, that was the inducement we're looking for. Market engineered the liquidity right here without even tapping into the mitigation block. It moved up. What happened? Are we going to be waiting for market to come into our order block before we take a trade? Where is the block point of interest close to liquidity is this. So what happened? Market came, tapped into it, and you saw a sweep. So this would have been an entry, and this would have been an exit where you want to take profit. A beautiful trade, right? Same scenario happened here. Okay, this is the example. So um I don't want this video to be too long. On our next video we'll be doing more, right? So let me just zoom this out so you guys understand it. So you just need to go and check your chart, back test, take note of this structure. As I've given you guys the bullish when, the on the bearish scenario here, the bullish scenario. You need to take note of it. It will help you if you know how to trade off a breaker block, if you know how to trade off a mitigation block, you know how to trade off an imbalance. On the next video, we're talking about how to trade on an imbalance and all. It's going to help you, right? It's going to really help you not to miss entries. And of course, if you have real, and make sure you always have a realistic profit target. We're going to be doing another video to talk about realistic entries and exits. A lot of people will take entries, but they will set their target so far away, right? And market can shift structure at any given point of time, and before you know it, your market will reverse and come back to your entry, or you end up missing out on that particular trade. So now next video we'll be discussing more and more, but want you guys to actually look at these patterns very well and go and back test. That's the only way to know it. Go and back test, and you can ask me questions any given time. So thank you very much, guys.